Hello and welcome to Macrosutra. This is Akanksha Mishra. Moody's, a premier credit rating agency, has just downgraded US credit rating from AAA to AA1. And this is the first time in over a century that the US is not at a AAA credit rating. Impacts have already started. In fact, the Indian stock market fell today by about 1%, and the impact is being attributed to the US credit rating. But that's just the tip of the icebergs. There's going to be a lot more impacts on US markets, global markets, Indian markets. And to discuss that, we have with us Radhika Pandey, Associate Professor at NIPFB. Thank you for being with us, Radhika.
Thank you, Akanksha.
So, Radhika, what has been the immediate impact of the credit ratings on US Treasury bond yields?
So, see, we have to see what led to this downgrade. So, that is important because what Moody's say in their rating rationale is that over the last decade, we have seen that US fiscal performance has been sliding in terms of the fiscal deficit has been rising, the debt has been rising, and therefore, by implication, interest payments are rising and interest costs are rising. And the main reason for this has been that tax cuts have led to a stable revenue. Revenue growth has not picked up, whereas expenditure has been growing. So, overall, if we look at the key fiscal metrics, namely the debt to GDP ratio, the fiscal deficit, the revenue to GDP ratio, expenditure to GDP ratio, all of them have shown a steady decline. The performance has been declining over the last 1 decade, and therefore that is also getting reflected in bond yields because the cost of borrowing is rising because interest payments have been rising. So that is the main reason for Moody's downgrading the US economy from AAA to AA1. And this is the final out of the big three credit rating agencies. So we have S&P, Fitch, and Moody's. They had already downgraded. S&P downgraded way back in 2011, Fitch in 2023, and Moody's in 2025. So since 2023, there have been these growing concerns about the deteriorating fiscal performance of the US in terms of rising bond yields, the debt has been rising, and so on. And the concern that has been raised is that successive administrations, be it Democrats or Republicans, they have not been able to improve or reverse the fiscal performance. And therefore, they expect that over the next decade, the performance is going to deteriorate even further. The debt to GDP ratio could rise to 134, 135% of GDP. It's very high. Similarly, the fiscal deficit, the federal fiscal deficit could rise to above 7%. So all the fiscal metrics are going to deteriorate, and what could further exacerbate this situation is the fact that the current administration is bringing a lot of legislations that are geared towards tax cuts, and that could further harm the fiscal performance because during the first tenure, Trump got what was called the Tax Cuts and legislation on Tax Cuts and Jobs Act that was mainly towards overhauling the income tax and corporate tax cuts. And now they expect that the individual tax cuts are ending in 2025, so they are going to extend it. So on your immediate question, what happened after the downgrade was that the bond yields started to rise further because there were these concerns that because of these legislation, they are coming up with something called a big beautiful bill, which includes all these new proposals towards tax cuts, an increase in entitlement spending, and so on. So all that would deteriorate fiscal performance. They also came up with auctions of their treasury bills, and there was hardly any demand for that. So bond yields are rising further. So all in all, because of the deteriorating fiscal situation and the proposals that have already been put forth in the Congress, and they have crossed two hurdles, it shows that those those proposals would be passed, and that would have further deleterious impact on the fiscal position of the US.
Right. So you also mentioned how, Moody's mentioned that one of the main reasons is the rising fiscal debt. But alongside a stable tax revenue, I'm sure there's been an impact on the US's debt affordability ratio. That's what you
Correct.
mentioned in the article. So, can you tell us a little bit about that?
Yeah, so that's a very important fiscal metric. The debt affordability is actually interest payments to revenue. It shows the ability of the economy, or it can be applicable to a business also, to a household also. It shows that how much proportion of your revenue is going towards payment of interests. So, if the fiscal performance deteriorates, if the debt burden is rising, if the stock of debt is rising, that will lead to higher interest payments, and once the interest payments are higher, interest costs will be higher, and that will get reflected in the debt affordability. So debt affordability is interest payments upon revenue. So what is happening, particularly since 2021, what we are seeing is, if you look at the trajectory of bond yields, be it 10-year bond yields or 30-year bond yields, they have been rising. So even though there is a demand for US assets, because US is still the reserve currency, and emerging economies invest their forex reserves in dollar and dollar backed assets. But what is happening is that there is now some level of caution that, okay, the US is till now was able to finance its debt at low cost because of its reserve currency status, but all that position now might be up for a change, because now this is the first time, as you mentioned, that all the three credit rating agencies have downgraded. And as we'll discuss later, that there are nuanced differences between the previous instances of downgrade and this instance of downgrade. So things are changing, even though gradually, but things are changing. The going forward, the appetite for US bonds and US dollar backed assets could show a decline, not only because of Moody's downgrade, but because of these policies which are further leading to a deterioration in the fiscal performance of the US.
So, speaking of policies leading to a further deterioration of US fiscal health, I don't think we can go by an episode without mentioning the tariffs. So, is the new tariff regime by Trump going to have any impact on this scenario?
Yeah, so again, that's very important, because on the one side are these set of policies which are aimed towards tax cuts. The extension of the Tax Cuts and Jobs Act, which was introduced in 2017 during the first term, which, as I said, mainly aims at reducing individual taxes and corporate taxes. Now, the provisions of corporate taxes are permanent, so corporate tax rate has been reduced from 35 to 21%. But the individual tax provisions were legislated in a manner that they have to be again voted. So they are ending the provision. The reduced individual tax rates are ending in on 31st December 2025. So they need to extend the tax cut provisions pertaining to individual taxes. So if all of these are implemented, as I said, it will lead to deterioration and widening of the debt and deficit, because revenues will decline further. And to further exacerbate the situation is the tariff policy, because of the tariff policy, the central bank, the US Federal Bank, is not able to cut rates, because tariffs are inflationary in nature. When tariffs are introduced, they act as a kind of a supply shock for the US economy, the tariff imposing economy. So prices are set to rise in the US economy. So while we already have seen 75 basis points cuts by the US Fed, but in the latest meeting, they did not cut rate. So going forward, it will become difficult for the Fed to cut rates, and they might even have to raise rates. So if they have to they cannot cut rates, that means that the borrowing cost will not come down at a time when interest payments are already higher, interest costs are already higher. The policy preference towards having tariffs and elevated tariffs is further complicating the situation.
So, coming back to something you mentioned, Radhika, which is that Fitch and S&P have already downgraded the US. Moody's was just the third to join their ranks. But there was a difference in the context and the impact of those downgrades back when they happened, one in 2011, one in 2023. Can you tell us a little bit about what was the difference then versus now?
Yeah, so S&P downgraded in 2011. So, in fact, during that time, nothing happened. In fact, it actually led to a rally in US bond yield. If we look at the trajectory of the 30-year bond yield, we see that the bond yields actually fell. That means that the bond prices rose and yields fell. So, there was a greater demand for US bonds. So, it led to intensification of the flight to safety mode, and therefore there was greater demand for US bond. But if we look at the latest two instances, which is the Fitch and Moody's, Fitch in 2023 and Moody's now on 16th of May, now we see that the bond yields have risen. So context is different. What is happening is that they have a very peculiar fiscal framework where the Congress has to vote on the debt ceiling. So they have to, whenever the debt ceiling is approaching, they have to either vote for increasing the debt ceiling or suspending the debt ceiling. And if they do not do, for some time, it is possible for them to work through, because there's something called extraordinary measures through which they can tide over for some period of time. But around the some period, they have to take the decision of either increasing the debt ceiling or suspending it, so that they can, do their normal day-to-day activities and not just rely on extraordinary measures. So in 2011 also, it was due to, at that time, the downgrade happened mainly due to this political standoff around the debt ceiling, where Republicans and Democrats were not agreeing, but finally they agreed, and therefore it actually led to improvement in the bond yields, and even the dollar also strengthened during that time, and emerging market currencies fell. But in the last two instances, when we look at bond yields have risen. The US bond yield risen, mainly saying that there are the concerns around the fiscal situation of the US actually started from the Fitch downgrade from 2023, and they have been further reiterated by the Moody's downgrade. But even during that time, even during Fitch downgrade, which was in 2023, the dollar index actually strengthened. But this time around, the dollar has also been weakening, and US bond yields are rising. So now the trouble that got initiated, where people got to they started thinking that all is not well, and it's not possible for emerging economies and other economies to just keep investing in US bond yields at low cost. That will not sustain. If they are investing, they will ask for a higher premium on the investments in US bonds. So that started to change from the Fitch downgrade of 2023. So that was the difference. But this time around, as I said, both the metrics, which is the US bond yield, the 30-year bond yield actually rose to almost 5%, which is like a psychological mark. Even the 10-year US bond yield rose to 4.5%. And because all these US bond yields are rising and Indian bond yields are stable, so the differential between the bond yields have narrowed now actually to a 20-year low. So which has implications for capital flow that we'll talk about. But it is this thing that the borrowing cost will now start to rise going forward. We'll have to wait and watch for the data that comes out after a lag of 1 quarter to see what happens to the holding pattern of bonds, because there are these funds who hold bonds in triple A rated economies. Do we see a change there? So that we'll have to wait for that data, because that comes with a lag. We also have to see what happens to the holding pattern of US Treasury yield. So that all will be interesting to see. Right now, we only have initial reactions, and initial reactions show that bond market did not like this downgrade, and therefore the bond yields rose. And going forward, also it's the bond market that's going to punish the administration. Even for the tariff thing, we remember that 2nd April they had introduced the reciprocal tariff. 9th April they had to roll it back because of the rise in the bond yield. So rise in bond yields is a very serious thing because it leads to an across the board increase in borrowing costs, not just for the government. 10-year bond yield is a benchmark for borrowing costs for households, for mortgages, for businesses. So across the board, there is going to be an increase in borrowing costs, and that is something that the administration will have to take note of.
Right. Now, finally, coming to what the impact of this is going to be on emerging markets like India.
Yeah, so that's what we mentioned. One is that there will be some bouts of capital flows volatility. There will be bouts of stock market volatility, as you mentioned. That now there are these growing concerns around the U.S. fiscal health, and there are these growing concerns about not just the immediate but the long-term fiscal health, because sooner or later they will have to decide about raising the debt ceiling, which is currently at $36.1 trillion, already quite high. So they will have to decide on whether they suspend or whether they raise the debt ceiling. So that is one. So these concerns are leading to volatility in emerging markets, but more importantly, because the yield differential between Indian and the US bond yield has narrowed, it will lead to outflows from foreign portfolio investments, outflows from debt. And that is what we are seeing. If we look at FPI net investment in debt, we are seeing that FPIs have turned net sellers in debt. So overall, there won't be any major impact, particularly on India, because we have domestically done a lot of reforms also. If we look at RBI recently introduced a lot of changes in its capital controls framework to allow more FPIs to invest in short dated debt, which was not there earlier. Earlier there was this restriction of 30% of beyond 30% cannot be invested in short term debt. So we are trying to make our debt investments more lucrative for foreign portfolio investors. But these instances of the shocks in the US economy will have impact and will lead to volatility. That is one. The other is that those economies that are reliant on foreign currency borrowing, they will have a problem, because then the cost of borrowing will rise, because the US bond yields are rising. So the cost of borrowing will rise. They will have to issue bonds at a steeper yield, which will further deteriorate their fiscal performance. So it's more harmful for the other countries that are reliant on foreign borrowing, because overall going forward, there is going to be a period of financial tightening. There is going to be investors, if they are willing to invest, they will demand a higher premium. So that will lead to a tightening of the borrowing conditions.
Right. So moving on to audience questions, there's a couple by Sankalp. So first he asks, is there any indication that the downgrade is significant enough to force a political policy correction in Washington?
Very good question. So, whether it will force a correction, that ultimately depends on what happens in the bond market. Because if the bond markets react aggressively, and if there is this the immediate reaction that we saw in terms of rise in bond yields, the 30-year bond yield and the 10-year bond yield, if this increase in bond yields continues, then it will force some course correction. Certainly, it will force some course correction, because there is going to be, as I said, across the board increase in borrowing costs, not just restricted to the government. And then some course correction would have to be taken. They would have to arrive at a consensus about their debt ceiling. So it's not just the Moody's downgrade. Moody's downgrade is it's actually a backward looking indicator, because we already knew that the US performance was bad. We already knew that debt to GDP ratio, currently the debt to GDP ratio of the US is one of the highest in the world, above 120% of GDP. So we already knew. It was just like telling upfront that, okay, there's a problem with the
Yeah, it
US.
was flashing a light on what the problems was.
Yes. So now what happens next is going to be more important, that whether they are going to, what they are going to do about their big beautiful bill, which has a lot of provisions that could further deteriorate the fiscal position, whether the bond market is going to punish them or not, or investors are still going to go ahead with aggressive dollar buying. If the bond vigilance act with certainty, then I think there would be some course correction.
The second question from Sankalp is that whether the increased treasury yields is significant enough to trigger flight of capital and leave our markets dry.
Yeah, that is there because, as I said, the bond differential has narrowed to now 20-year low. It's around the difference is around 160, 165 basis point, quite low, and that could trigger movement away from EM bonds to the US bonds, and that could have implications for our exchange rate as well. And what could further complicate the situation is that while the US Fed has kept its interest rate constant, RBI in its June meeting is likely to cut rates further, and that will further narrow the differential between the Indian 10-year bond yield and the US bond yield, and could further propel the outflow of capital. So that is something to watch out for.
Great. So we've seen how the Moody's downgrade basically was because of increased fiscal debt in the US, increased fiscal deficit. The reason for which, as we discussed, lies in a number of reasons: stable tax revenue, burgeoning interest payments, which obviously has an effect on US's debt affordability ratio also. The immediate effects of the credit rating we obviously saw is in the investors taking note and reevaluating their confidence in US Treasury bonds. As Radhika's article says, this might just be the beginning of a new era for US debt, and maybe it's era of unlimited borrowings with stable inflation and with lower interest payment rates. Maybe that is going to change soon. But we'll have to wait and watch. That's all we have for you today. Thank you for tuning into The Print.